if you look at the chart, they knocked the hell out of silver. It was down considerably, and then actually within a half hour was in the green, went up, and gold pared back roughly half of its losses. So there was some of that involved. But again, the amount of contracts that were dumped to push the price this low also would trigger other automated sell signals that a lot of these funds will be automated by black box trading systems where levels are breached, they immediately trigger sell stops. And that's what would have happened. So a lot of people were sold out of their positions while they slept at night. And those that were knowing what was coming were able to come in and gobble things up on the cheap. Not all of it, but enough to certainly benefit some of the players who knew what was coming.
The recent turbulence in the gold and silver markets is revealing cracks in the very core of the global financial system. A massive dump of paper contracts sent precious metals tumbling overnight, triggering automated sell programs and liquidating unsuspecting investors, while insiders quietly bought the dip. Yet beneath the surface, this looks less like panic and more like coordination, a deliberate flush to reset sentiment and regain control. Such moves often mark key turning points at which physical demand begins to outweigh the illusion of paper supply. Both gold and silver remain in confirmed uptrends, with silver nearing oversold territory, a technical setup that historically precedes strong rebounds. AndySchectman, CEO of Miles Franklin Precious Metals, explains that this manipulation could be part of a much larger strategy. Behind the scenes, U.S. policy architects may be engineering a quiet revaluation of gold to devalue the dollar, support manufacturing, and rebalance global trade, aligning with recent policy ideas like the Genius Act. As talk of gold-backed systems and debt relief through hard assets resurfaces, it's clear that monetary power is shifting toward tangible wealth. Now we present the clips from AndySchectman's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
What is the motive? What is the motivation? Is it the U.S. government coming in and really not wanting the light to be shown upon gold at that level because they're still trying to accumulate it, or other entities, other banks that are getting margin called, looking at severe stress in the London market, trying to drive the paper price down to protect themselves, to cover their positions? We could pick a million reasons why it's happening, but to me, the why is less relevant, as is the how it happened. And in any of these instances, if any of these players wanted to do things legitimately, it wouldn't have been done the way that it was done. It was done to rattle the market. And maybe it was to, the retail investor. Over the last several weeks, I was just in Aruba for 8 days. I never saw the ocean for more than 30 minutes because we were working nonstop. Business has been accelerating tremendously. It's starting to catch the eye of the mainstream and of the public. Maybe that's not what they wanted to see. This was a flush. Now, at the same time, look, a flush, you could argue, would have been inevitable after 9 weeks of going straight up and moving in a way that freaked a lot of people out. Never seen anything like this. But to your point, gold is no longer overbought as it was since late August, which is a good sign. It hasn't quite yet reached oversold, but what's interesting, silver has also confirmed an uptrend. Both of them have been an uptrend of a 200-day moving average, both of them continuing up. We haven't seen lower lows yet, but what we see with silver now is that it has already nearly reached its oversold levels, and that's something very bullish, a technical indicator that should say that maybe the flush in silver has stopped. And in the short term, we should expect it to rebound. We could see a little more weakness in gold because even though both are no longer overbought, silver technically is no longer oversold. Gold, not quite there yet. So from a technical standpoint, sure, there is some merit in what the mainstream says. The application of how it came about is flawed. And to not bring that up is only telling half a story. And I think that's the part that the mainstream really is divisive about, and why so many people never understand what's happening, because they hear what they're saying and there's logic to it. But if they understood how it was actually implemented, they might look at it with cross-eyed. a $250 drop in gold, yeah, it makes you want to puke, but it doesn't get you scared. It tells you you're getting closer to the point where the physical demand overwhelms the ability of these paper charades, these paper drubbings that we haven't seen for quite some time, to be honest with you. But here it is again, and this one really reeks of desperation, as you can see by it happening one in only 240,000 days in a normal market. Well, yeah, I mean, I think that is very much the case. I mean, whether it be Tether doing it by the issuance of stablecoins, what they will be doing, and putting the interest that is generated on those treasuries will then go into more treasuries to force rates lower and into commodities like gold to continue to devalue the dollar, like Bitcoin, perhaps to raise the price of Bitcoin to ultra high levels to pay off the debt. I mean, I do believe that. But at the same time, when we're seeing these massive influx deliveries into the COMEX market and no one talks about who is actually buying it, I do believe that Secretary Bessent is part of it. The Secretary also controls the Exchange Stabilization Fund. And if it were being done for national security and part of a bigger agenda, it wouldn't need to be reported. You wouldn't need to get congressional approval. I think it is too coincidental when you see Secretary Bessent say he wants to take part in a new monetary system, which I argue is the stablecoin passage or the Genius Act, that he wants to remonetize the asset side of the balance sheet. I think it is ironic when you see President Trump say he who has the gold makes the rules. And as we've talked about at length, both you and I have interviewed Judy and Shelton, and she said he's going to back the back end of the treasury market with gold. My thesis, in essence, is gold's revaluation higher, whether it be organically for a long time, as Luke Groman says, it will get to 6,000 or 7,000. Interesting that the head guy at Jefferies says 6,600 is their next target, and then they'd revalue it from a higher level. It is not to push gold higher; it's to devalue the dollar. And I just think that this is the agenda, whether it be organically or in this case, synthetically through Tether. I think that the idea is to let gold go higher to devalue the dollar to make, and that's in essence a good portion of the Mar-a-Lago Accord. Stephen Mirren, who's Trump's advisor, now filling the vacated spot at the Fed, to make manufacturing more attractive. And if we take Judy's part, backing the long end of the treasury market with gold, you can bring back manufacturing with no upfront borrowing costs. You have to redeem it in gold in 20 years, fine. So let it go higher. But in the meantime, you bring back your manufacturing at very, very low, if not zero, upfront borrowing costs, redeemable in gold later, and you use the continual synthetic accumulation of gold through the Genius Act and the Treasury purchases. You know, when you spend those stable coins, they're burnt, they're gone. But the interest on the Treasury is not. Tether gets to make all that money, and they are required to buy more Treasuries to continue to suppress rates and buy those commodities. That's the part that no one's talking about. Buy gold, buy Bitcoin, use Bitcoin to pay off the debt. That's my opinion, and don't know if it's true or not. And use gold to continue to devalue the dollar to make your selling of products around the world attractive. In essence, you're defaulting on the reserve status. Griffin's dilemma. We've talked about Vice President Vance saying that that's exactly what should happen. We should lose it. And the knucklehead, I forget his name, but the knucklehead that was the lead economic advisor to President Biden, the guy that tried to explain how treasuries were created, it was just a joke.
I know who you mean, and I forget his name too right now.
But he is a true knucklehead. But he wrote a report called Dethrone King Dollar, and you can link to it in the show. That was in the New York Times or the New York Post or one Wall Street Journal, one of those New York newspapers, where he says it's no longer an advantage to the United States to be the world reserve currency. You're getting this from multiple sources. So yes, I do think ultimately that's where they want it to go. But as Vince said this morning, by devaluing or debasing the currency so much so fast, it really doesn't do anything but make the debt burden a little easier. It actually is hurting the economy. considerably. So maybe they just wanted to back off a little bit at the pace at which it seemed to be accumulating. But I think there's truth into what he's saying, and you have to kind of read between the lines in all of this stuff and use common sense to kind of figure out where we're going.
In the early hours of this global trading, a massive wave of gold and silver futures contracts was dumped onto the market, a move too coordinated and too illogical to be accidental. Silver prices briefly plunged below $50, and gold fell by $100 before rebounding, suggesting a deliberate attempt to trigger automated sell-offs and shake out weaker hands. This was not profit-taking. It was a calculated shock and awe event, designed for maximum psychological and market impact. Yet, despite the manipulation, buyers' resilience was immediate. Within minutes, both metals recovered sharply as large institutional players stepped in to scoop up contracts at fire sale prices. The footprints of major banks and asset managers are all over the rebound, with analysts now raising long-term targets for both gold and silver. Behind the scenes, the narrative is shifting, from suppression to accumulation, signaling that powerful interests may now be positioning for a historic revaluation of tangible assets. Let's get back to the interview.
Look, we blew through 2,000, never challenged it. Blew through 3,000, never challenged it. Blew through 4,000, still haven't challenged it. We may, but as we said, support a step back in. But when you follow the narrative, the conventional wisdom of the mainstream, and some of what they say is legit based upon what I just said, and blowing through these averages, $50, $70, $100 a day moves, that's unprecedented to the upside. But when we look at what happened in the middle of the evening last night, where in the thinnest part of the trading cycle, when New York is fast asleep, someone or some entity or a coordinated effort dumped a massive wave of futures contract onto the market. Again, when New York was fast asleep, this drove silver under $50. It knocked gold down $100. But then something interesting happened. I mean, this was shock and awe, Michelle. This is a drive-by shooting, right? Any trader that would be stupid enough to dump that level of futures onto the market at the thinnest trading segment of the day, when there's virtually no liquidity, would be fired and shot, and probably not in that order. And it was specifically done for effect. But what was interesting is that we saw players come in almost immediately right after this happened and push the price right back up. Now, is that physical buying? Is it knocking down the paper price and coming in and buying the physical to cover the shorts? Maybe. We don't know who it is. We have an idea. Watching or reading Michael Lynch gives us a good idea, a little bit of a snapshot. He comes out and says straight out that this was an engineered crushing by the paper shorts. They're behind it, behind the scenes. But someone came in and snapped up at a record pace. He thinks it's Bank of America and Morgan Stanley. The interesting part about that is it was a month ago where the chief investment officer for Morgan Stanley came out and said, yeah, you know, the 60-40 mantra we've been talking about for so long, we think we should sell 20% of the bonds, 60-40 being the Wall Street steadfast way of investing, 60% stock, 40% bond. He says, no, let's do 60-20-20, 20% bond, 20% gold. Well, Michael believes that there are footprints of Morgan Stanley and Bank of America, whose high price analyst, Michael Hartnett, whose newsletter I believe is at least $10,000 a year, only speaking to the institutional traders, came out and said, no, it should be 25, 25, 25, 25, 25% stock, 25% bond, 25% short-term treasury, 25% gold. Bank of America last week raised their target on silver to over $66 or $67 for next year, with an interim price, medium price between now and then, or an average price of somewhere around 57. He goes on to talk about that since October 17th, 6,000 new immediate delivery contracts were written, which is all but a record for this late stage of the delivery cycle. And he goes on to say, if the pace continues, it could be one of the biggest delivery months ever on record, challenging the February and March deliveries. So in other words, the market got bombed by paper in the middle of the night when no one is trading and New York is asleep, which provides all the liquidity. But yet someone came in and gobbled a whole bunch up. And at the same time, we saw 11,000 paper long contracts closed out. So this is a very unusual drive-by shooting for effect type of sell-off. Yet some of the fundamentals that are cited by the mainstream and the markets can stay overbought for a long period of time. But to ignore how the sell-off occurred and just simply say this is profit taking is ridiculous. It's just not good reporting is what it is, because any normal trader would have spread that out during the most liquid time of the day in New York trading over hours or even days to maximize that level of return, not dump it on for effect. And that's exactly what happened. And I think that is something that should be taken into consideration as we continue to talk about what's going on. If you look at the chart, they knocked the hell out of silver. It was down considerably, and then actually within a half hour was in the green, went up, and gold pared back roughly half of its losses. So there was some of that involved. But again, the amount of contracts that were dumped to push the price this low also would trigger other automated sell signals that a lot of these funds will be automated by black box trading systems where levels are breached, they immediately trigger sell stops. And that's what would have happened. So a lot of people were sold out of their positions while they slept at night. And those that were knowing what was coming were able to come in and gobble things up on the cheap. Not all of it, but enough to certainly benefit some of the players who knew what was coming. In the access market, could have been in between. It was probably in between the closing of Asia and the opening of London, somewhere in that period of time where the main price setting is done in New York. The traders who would provide the liquidity, the big banks, would be found in New York City. And if you are going to execute a trade, you don't, if you wanted to sell $25 million worth of a stock in a thinly traded market, you don't just dump it onto the market to cascade the price and get the worst settlement. You would do it over time, slowly, maybe through multiple entities, not trying to spook the market, but by dumping it into a market that is thinly traded, meaning not in New York and not even when London is fully operational or right as China is closing. You're talking very few players are providing liquidity. It is going to provide the worst possible settlement you could possibly get. It's done for effect. It would not be the way that any trader with half a brain cell would ever try to maximize return for their client or for their own position. And it is specifically done to drive down the paper price.
The overnight sell-off in gold and silver wasn't random. It was precision engineered. Massive paper contracts were unloaded in the thinnest trading hours, sparking an automated wave of liquidations that punished retail investors and rewarded those who knew it was coming. Buyers stepped in, reversing losses within minutes and proving that real demand for precious metals remains unshaken. This wasn't weakness. It was a stress test, and the market passed. Events like this reveal a more profound truth. The paper market can temporarily distort prices, but it cannot suppress real value forever. As institutional players quietly increase allocations to gold and silver and delivery demands on COMEX surge, the system edges closer to breaking point. When it does, paper games will no longer matter, only possession will. The foundation of trust is shifting back to tangible wealth. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.